Good evening, viewers. This is Suresh Parthasarathy trying to bring in Mr. Trideep Bhattacharya for you. He is with the PJM from SP Jain Management and Research Institute, Mumbai. To his credit, is having a BTech with him. Before he was joining Edelweiss Asset Management Company, he was working with the Axis as a portfolio manager and alternative equities. And previous assignment was he was working with a portfolio manager with State Street Global Advisors and US Global Asset Management Company in London. And he is now currently managing assets as a CIO for Edelweiss. Now I'll take the floor. Welcome, sir, to my channel.
Thank you very much for inviting me, Suresh.
Yeah. So there is a mixed audience in our channel. There will be Tamil as well as English audience are there. So what I take, I'll try to ask some question in English and followed by Tamil also for my the viewers to get connected. So what is your view on market? Market view, what is your view, sir?
So it's going to take a bit of a time. So, I would say that every year, beginning of the year, I come around with a view for how the year, in my opinion, is likely to look like. Okay. And beginning of 2023, we came out with a view that this year can be kind of summarized in the form of recession before rebound. And essentially what I meant by that is for the first 6-9 months of the year globally, we would probably be in recessionary conditions as defined by slowing growth rates, okay, estimate cuts, and generally negative headlines. Okay. As we go towards the end of the year, we will start seeing peaking interest rates, peaking inflation, at some point bottoming of economies, and then a rebound. And hence okay, the theme recession before rebound. Now, when I put that out roundabout in January, people were a little confused whether rates have already peaked or not. And okay, my sense was that overall, I think we have a lot more to go because inflation, in my opinion, was likely to be sticky. Okay. Standing towards the middle of this year, it certainly, if you look at the data points that we have seen since the beginning of the year, data points have been more in terms of stickier inflation, cut in earnings estimates globally, and in countries where fundamental growth rates were weak, there were recessionary conditions. In others, we saw growth slowdown. India would most probably fall under growth slowdown category. Okay. As we look forward from where we are today, we are gradually coming nearer to peak inflation, peak interest rates, and over a period of time, rebound in economy. And that is where the constructive hypothesis on equities really starts. So from moving from near-term view, which is 2023, to medium-term, in my opinion, as we gauge through the horizon on the rebound of the Indian economy and Indian markets, I would say that the next 5 years are likely to be kind of fairly strong for India from a bottom-up perspective. That's my medium-term view. And the reason why we think that the medium-term view for India is actually positive is because as we go towards the middle of next year, we have elections coming about. And assuming a stable macro outcome, we think that there are 5 themes which actually reverberate very well with the Indian economy. And those 5 are, first of all, we think there is a good chance of a private sector-driven capex cycle to come through, given where capacity utilization is for the economy at about 74-75%. We think for the first time in the last 10-15 years, there is a good chance that we will see private sector capital investment starting to happen, something that we haven't seen in a while. Second, overall, so this has implications. The first theme has implications for the industrials, capital goods sector, and we certainly are overweight in those areas, and we are quite positive on that theme. Secondly, I believe that after going through 3 or 4 fairly tumultuous times of NPA cycle and corporate deleveraging, lending financials offer good risk-adjusted upside for investors over the next 2 to 3 years. Factoring this in, most of our portfolios are overweight lending financials in various shapes and forms. The third theme that we are positive on are basically that we think over the medium term, from a 5 to 7 year perspective, the real estate sector is probably bottoming out.
Okay.
We think that we are somewhere in the first 2 to 3 years of this theme. In that context, we see minimum of 12-year low in terms of household unsold inventories. And as we see a rebound in this area, we think that we're good for broader economy as well as the equity markets. The fourth area that we are positive on is basically, defense. We are quite positive about indigenization of defense. We think this is a 5 to 10 year theme or even longer. We think that Indian companies who position themselves better to cater to this theme would have their medium-term order book fairly full. This theme is more governed by, how much capability with which they can serve rather than the broadness or the richness of the theme. So that will be the fourth theme that I would talk about. And finally, I would say that the China plus one outsourcing theme is gradually morphing into a Europe plus one theme, where increasingly corporates from developed world like Europe are also looking to use India as a manufacturing base, similar to what we saw in IT services a couple of decades ago. So a combination of these 5 themes make me quite positive from a medium-term standpoint on Indian equities. But before we get to that, we have a bit of a turbulent, flattish markets, so to speak, which is 2023, which in my opinion should be seen as accumulation phase for better times to come. A verbose answer for your first question, but I think that probably sets the conversation, in my opinion, in the right way.
Fine, sir. Thanks for giving a 5-point agenda for the markets go ahead. So there is always investors that my portfolios are not performing to great extent what I was anticipating, because every investor expect that every year market should give 15% of return. So now, because last close to 1 to 2 years time, market has not given really give a comfort for investors. As an investor, what are the trigger points I should look at it to get a comfort on my investments?
I think it's a great practical question which investors face day by day, and thanks for asking that. I think the first thing that investors should know that from a market point of view, time spent in the market is far more important than timing the market. And a lot of investors try to time the market, come in at a time when they feel positive, but at the time when markets are overheated. And then what happens is over time, as markets gradually stabilize, net the market return doesn't really match the investor return. Okay. However, just to quote a data point, our midcap fund, for instance, just as an example, historical data, which has been around for 15 years, has given an XIRR of close to 17%.
Okay.
So, which means have the investors stayed put for that long? Over that lengthy time frame, we have seen booms and busts, good times and bad times, but net the returns have been fairly robust. So the first thing that investors should keep in mind is stop looking for triggers and think about long-term and how they can stay invested in whatever fund, or particularly when they're coming to equities, they are invested in. That's the first thing that I would say to an investor. Second, I would say that overall equity markets do well when generally interest rates have peaked, inflation have peaked, and earnings estimates starts to go up. I think over the last 6-9 months or probably longer, we have seen earnings estimates kind of going sideways globally. In India, in pockets, they have gone up, but in an aggregate, earnings have not gone up. And that's probably the reason why markets have been flattish over that time frame. The key to, from an investor standpoint, to keep in mind is to invest in those companies where earnings estimates are still going up despite aggregate earnings being flattish. And that is what we try to do at Edelweiss Mutual Fund with regards to our long-only funds. And as long as we stay true to that, overall, we see a good amount of equity returns on a bottom-up basis, even though the broader market might be kind of, flattish. So from a trigger standpoint, market, I would say that inflation peaking, interest rates peaking, economies bottoming out are the key macro data points that one could keep in mind. But most importantly, get invested in tranches and stay invested would be my mantra for the investors.
Okay. So as an investor, you have given 3 points that investors has to stay invested, and you said that Edelweiss midcap over at 10-15 years of time has given 17% plus CAGR for an investor. So now there is another point. Now always get confused, because I always follow an asset allocation and invest. When I see set on the reports that 23-24 going to be mid cap and 24-25 is going to be small cap, as an investor, I'm getting confused. Do I need to follow asset allocation, or depending upon the climatic change, I need to push more money toward mid cap, more money towards EQ, small cap, and rebalance my portfolio? Just to throw light on that, I was an investor, I manage an asset allocation. This type of information makes me a little confused. What I have to do?
I think first of all, as an investor, asset allocation is important. And asset allocation should be commensurate with the risk objective or return objective and the risk profile of the investor. And the risk profile and the return objective of the investor is best gauged by someone like yourself, the advisor, who can speak to the investor and kind of get a sense of where they lie on the risk spectrum. Based on that, the asset allocation should be decided in conjunction with regards to advisor. If you swing around based on the fad at the moment, it is almost a recipe for disaster. And the best thing to do is, based on the age and the risk profile and the risk profile and the return objective, sit with the advisor, decide on an asset allocation, and stick to it, despite either contra headlines or, for that matter, kind of all the noises that we are surrounded with, whether it is stock market related media or social media or other areas which can confuse you rather than direct you in the right direction.
Yeah. So then the point, and further I want to escalate this point. So now I know that index and Sensex are Nifty and Sensex are close to their all-time high. Maybe a 1.5% have been shortfall from its all-time high. Whereas look at my own portfolios, my investors' portfolios are not catching up with that. There is a lag effect is there. So what I have to do with that? Do I expect that I'll have a lag effect, I can able to overtake it, or I need to wait till that triggers, any triggers like a election or something like is coming, or any opinion polls coming, or that trying to wait till that's a time?
So I think fundamentally the market transfers wealth from the one who trades a lot to the patient one.
Okay.
Hence, the second thing that I would say, that equity markets tend to move in, or equity returns are generally quite lumpy in nature.
Okay.
And hence, staying invested is a great thing to be. You would have noticed that over the last 18 months, markets have been flattish.
Okay.
But before that, markets rallied from 7,500 as we came out of COVID all the way till about 1,800, practically doubled.
Okay.
So one could argue that the returns were made in advance, and the market is gradually coming to terms with the economy over the last 18 months. However, a couple of points that I would leave you with is that during this 18 months, if you were to do a stock selection, then those earnings of the companies would have gone up by about 15 to 20%, because that's been the earnings clip for Indian corporates overall. Assuming that happened, then the market's valuations are today a lot more reasonable at about 16 to 17 times 1 year forward earnings than they were about 18 months ago. Okay. So I would say today, as we speak, from a forward-looking point of view, the valuations look reasonable. They are not die-hard cheap. They are not very expensive. They are somewhere in the fair market-ish kind of a level. And overall, from here on, I would say the returns would be proportionate to the earnings growth of the portfolio of companies that an investor holds.
Fine. So now we also saw that the elections also plays a major role. We saw that in 2013-14, the 14 that the elections was coming and the new government has got elected. In 2013, third quarter and fourth quarter, we saw the market has really bounced back nicely. And after the government has got elected, market has not done well for next 1 year's time. See, now the new, if it is going to be the election year is going to be there, so investors can expect the similar trend like because third and fourth quarter of this financial year market likely to rally?
So I think it is very difficult to predict the short term. And clearly looking at Q3, Q4 would be predicting the short term.
Okay.
I would say that from a
Yeah, but one more point I
macroeconomic
just want to look at it is a continuation of government also. For example, if the same government comes, the continuation is likely to be there. Will that also give a trigger to the market?
So I would say that what market would look to draw comfort from is macroeconomic stability.
Okay.
And I think if we have a stable government post 2024, then those 5 themes that we talked about would actually gain significant amount of precedence and would drive investor returns over that time frame. Going the way it is going, it looks like it will happen that way. Now, whether the rally comes in Q3, Q4, or whether it happens post elections is very difficult to pinpoint and time. And hence, we reckon that investors get exposed to this market, particularly because it has been flat for the last 18 months from here to the year end in tranches. And hopefully, that when you look at the subsequent 2 or 3 years, when India's fundamentals driven by the 5 themes that we talked about continue to look very robust, returns actually follow. So my advice to investors would be invest in tranches in these flattish markets wherever you get weakness, and that exposes the investor nicely to equity markets and to returns thereafter.
Okay. Fine. Then I'll just now we know that there are certain sectors always give a tough time for investors. Now, although the banking sector has really rallied substantially, has given a comfort because of there is a credit growth is happening around. There is a demand for money. We know that after quite long time that the debt investments are seriously giving a very good return for investors. It could be a real return rather than because the real return people are seeing in a debt after quite long time. In such a scenario, there is a growth stock like IT sector. It's not doing a great. If you look at it, US technology funds have corrected 20-30% and still trailing for the last year. From 2021, it has not technically has not given, though it had a pullback rally of 10-15%. What is your outlook for Indian IT stocks as well as the overseas IT stocks?
So my sense is that overall, this should be seen as a continuum coming from COVID times. Technology as a sector did very well during COVID times, as practically we were all holed up at homes and did most of the things digitally. And that was reflected in tech spending, maybe which was higher than normal. And now what is happening post-COVID, as things are normalizing, is that the tech spend is gradually coming back to normal. That is all that is happening right now. And hence, the earnings estimates have been stabilizing. The stocks got very richly valued. If you ask around the time that you talked about, around about December 21 was the time when we went underweight tech sector actually, and that has worked very well for us so far. So it's basically the tech sector is gradually normalizing rather than kind of doing really badly. I wouldn't put it that way. And I think the normalization has 2 parts to it. One is valuation normalization, and second is earnings normalization. The valuation normalization has, in my opinion, already happened over the last 12 to 18 months. The earnings normalization is happening. I'm probably saying that's about 60% complete, maybe a little bit more remaining. Once the earnings or normalization is complete, that's when one would be very constructive on IT sector. At the moment, from being meaningfully underweight, we are probably marginally underweight in our portfolios. So we continue to be marginally negative. As earnings normalization happens over the next 2 or 3 quarters, we will probably look to take a constructive view on IT services, assuming everything else remaining same, and also from a stock-specific point of view.
Fine. Having we just covered the IT, I just want to understand your broader view on what are the sectors you are currently bullish, and what is your advice to small investors?
So I think in keeping with the themes that I mentioned, we talked about a private sector driven capex cycle. We are overweight. So in keeping with that, we are overweight industrials, capital goods, construction as a basket. In keeping with the second theme that we talked about, where we said that the lending financials are in a good spot, we are overweight lending financials in our portfolios. Third, we talked about real estate. We are certainly positive on direct and indirect plays on real estate in our portfolios. And finally, the country-specific themes like indigenization of defense and, which is a sub-part of capital goods. That's another area. And finally, chemicals, which lends itself quite well to China plus one or Europe plus one theme. So broadly speaking, industrials, capital goods, direct indirect plays on real estate, chemicals, etc. Net, we are overweight the manufacturing side of the economy and probably underweight the consumption side of the economy. We are overweight the domestic facing sectors and neutral to underweight the export facing sectors as we speak.
Fine. So now we were the lot of the fanfare was there in 2021 for overseas funds. A lot of themes are been coming. A lot of people are advising people to invest overseas. People have gone in 2021 into overseas funds. They really have burned their fingers. Let it be a China oriented or Asian specific or probably US based funds, something like a NASDAQ fund or technology funds or the global funds. So now from here on, an investor sitting on a negative, would you advise people to take exposure into global funds or they can wait for some more time before getting into that?
I think this is a very general question to kind of have a generic answer, but here is how I would say. First of all, international funds do fit into the asset allocation or should fit into the asset allocation of investors over the medium term. Second, these days, the choices available in front of investors, are really broad, starting with US tech to China. The entire world is at offer. What is important is to understand where one is invested in, and based on that, subject to asset allocation related allocations, one should allocate that much amount of money. So on net balance, I think it is very specific with regards to what that theme is, which one investor is looking to play overseas. But certainly, overseas investments or overseas allocation should be a part of asset allocation for investors.
Fine. So now then one more trend I see that there is trend is changing in the Indian mutual fund industries. Now predominantly there is a period of that we are long only, we go with a traditional model to invest on long term. The word quant has come and then completely taking entire industry, let it be AI is taking a new dimensions, and the chatbot is giving a new idea how to invest in mutual fund. In such a scenarios, there is a new way of investing, let it be at the momentum or maybe the algo based investments into mutual fund. You see there is a great chance going forward into that type of strategies?
I think there are many ways to nirvana. Likewise, there are many ways to investing. Okay. And I would not certainly kind of badmouth a certain part of way of investing than out of other. However, I think the basic investing tenets, which is buying low, selling high, importance of holding period, which is thinking about investing as buying a piece of the business rather than trying to do momentum trading or trading in general from a short-term perspective. I think these would be 2 or 3 kind of basic investing tenets, which I would follow on whichever by investing one investor wants to follow. The final thing that I would say, I am sure you might have noticed the recent TER-based regulations which have come about. In a sense, what the regulator is looking to sort of talk about is excessive trading could be bad for investors because it takes away from the returns. So as long as they meet all this criteria, the more the merrier. The more ways to manage the money, the better. We strongly believe that long-only investing is a lot about, understanding a trend or bottom-up company-specific dynamics ahead of time, staying invested for at least 12 to 18 months and reap the benefits over that time frame. We think that these fundamental core investing tenets have held true for the last 100 years and will probably hold true for the next 100 years as well. There are fads which come in and go, but net, I haven't found a better investing style than buying low and selling high on a bottom-up basis. That's what we do at Edelweiss, and that's what we would recommend investors to do as well.
Fine. So then one more final question. Now I'll come back. Now we saw that the IPOs were really fancy, and a lot of people have made quite a lot of money in short period of time. We also saw that a lot of new demat accounts have been opened, new investors have jumped, and then they thought making money in equity market is very simplest way to do things. Now the IPOs are getting dried up. Easy making of money has gone up. Those who come very late to the IPOs have burned their fingers. And I think Edelweiss also have one fund like an IPO related funds. In by and large, how you look at it, IPO market, and where it can seriously going to take us for investors want to make fast money in short period of time?
certainly one is looking to make fast money in a short period of time. Investing by the way of very concept is different from that. Fast money over a short period of time sounds a bit like gambling, which certainly we don't do. So I would certainly recommend that, the patient way of investing, which is identifying those IPOs where there is some uniqueness that they bring to the table, which come at reasonable valuations. And hopefully that can, be a part of portfolio of investors over at least 5-10 years, not to kind of get an IPO pop and go away. We certainly think IPOs tend to do, or number of IPOs tend to increase as market conditions turn more bullish, and over the medium term, as market conditions are likely to turn more bullish as we go through the recessionary conditions and we move towards rebound, we think there are probably better days to come. Overall, identify businesses which have some unique moat to them, that can survive not only downturns but also disruptions, and finally stick with them. Those would be 3 mantras that I would point to from an IPO investing standpoint. That's certainly what we follow at Edelweiss, and would encourage investors to do the same, to broadly land up on the right side of these IPOs over a medium term.
Thanks, sir. I think you have given quite a good lot of inputs on that. And because normally videos, we don't restrict to 30 minutes, people will lose interest. So this is what my thanks for you, because my viewers, I think definitely they'll get a benefit out of that. And I think we can frequently have once in 6 months about your market views and sectors and all that. Thanks for spending your time on a very short time of notice. And from our viewers' point of view, I'd like to say once again, thanks. And thanks, viewers, for listening. We are viewing this, and like that, a lot of interviews we will bring. And you have to take in that words of the fund manager who's managing so much of crores. Don't try to make money in a short period of time. Doesn't happen all the time. Probably a fluke could have made you that you are working in IT part time. You want to invest in stocks. You made quite a 2 times, 3 times, but doesn't happen all the time. And a fund manager breathes day and out, day out. Still, they struggle. They try to take a wrong stock, and I don't know why they struggle quite a lot to come out of that stock. So it's a mantra is that you have to be stay invested. As he said that Edelweiss midcap over a period of time, it has given 17% CAGR. You know that if you get 12% CAGR every 6 years, your money will get doubled. Then 17% means it should be shorter. At 4 years time, your money is going to get doubled. So you want to get double your money, have a patience and then stay invested. Definitely that help you to the wealth creation based on your asset allocation and goals. This is Suresh Parthasarathy, certified financial planner, founder, My Asset Consultant. Signing off. We'll meet in some other video. Bye then.